Good evening, TheoTrade. This is Corey Rosenblumen. You're watching the Theo Nightly video for the 12th of February, 2020. And we made a new all-time high in the market, but I think we've been here before. So let's go ahead and dig beneath the surface to this particular new 52-week high. Technically, it's an all-time high. And we're going to pick it up where we left off last time with an intermarket perspective. So what we're seeing here is the quad market grid. And there are some little warning signs, or at least things to be concerned about, or things that grab our attention. And here's what we're looking at. In the S&P 500, the S&P futures, this is an overnight chart that takes a look at multiple sessions, or really overnight sessions, and how we got here. It does take into account, or take off the account, those overnight gaps. And we've been seeing a lot of those in the equity market. Crude oil has been falling, slipping, going to the downside as expected, down away from 60 or 58 per barrel, all the way to 52, but it's gone a little farther than expected and is playing off of 50 in support. Keep in mind that crude oil and stocks tend to go together. They are positively correlated. So when one goes up, other goes up. When they both go down, or one goes down, the other goes down. But the equity market has participated in a stronger than expected, really or head-ripping rally, or it feels like it at least, when crude has not gotten off the mat. So that's something to watch as we go forward into this week and next, and the rest of February. On the flip side, gold and bonds over here are risk-off defensive markets. They tend to move together, and often, or at least more than not, tend to move opposite of the equity markets, such that gold going up when stocks went down, and of course bonds going up at the same time when stocks went down, and the market going up, gold going down, bonds going down. But as you can see in the right side of the chart, and an update from last Thursday's evening video, we called out a bull type of play in gold and a bull type of play in bonds. So we have had that bounce. But the one thing that's weird about it is that the equity market kept going. So that's got us scratching our head. Anyway, so that's where we start today's video and trade planning. So bullish equity market. Let's pull back to the daily charts of these markets and take a look at that S&P. That's a new all-time high. Really screaming toward 3400. The Nasdaq screamed above 9600, actually turned and reversed at the 9600 level. And nonetheless, I think this is where kind of the market went off the rails, and that a decent pullback, but these, the S&P might show it a little bit better, these gaps, that's just not normal. And on volume, that's declining. So here we are, new all-time highs. Get your bull caps on, but don't wear them too tightly, because this market's just a little too frothy or bullish or kind of chaotic, as opposed to this type of steady, stable, or not so gappy, not so choppy behavior. It's understandably resulting in frustration, maybe some losses, or defensive positions that aren't playing or paying like we would like. Still, we do recommend defensive positioning on the bigger picture. That's the S&P. Now to the Nasdaq. We have seen strength in the technology sector, which includes XLK, but a couple of news items, mainly that the Federal Trade Commission was doing some probes of some leading tech companies. And we'll see how that plays out. One day headline or something bigger. That does affect Apple and some other tech names. Facebook, Google, and the like. So we'll just take a look quickly at Facebook as it loads. And we see that it has pulled back from the 225, still uptrending. Let's actually take a quick look at all these names. Bear flag play to the downside, little bear flag here, and today's a gap and go to the downside. That is bearish. That's more or less a flag or a cradle type of sell trade. On Amazon, the exact opposite is taking place. We still have this earnings push the market to new highs, burst above 2000 and 2050, and then onward and upward. Keep in mind that markets move by supply and demand, so a lot of traders, even funds, or even some algo funds and the like, were short, bearish, or hedged in Amazon positions. So when the stock took out those highs, maybe a weekly chart gives us a better perspective here, right? Took out the highs, that led to some short covering, very quickly short covering, and extended the breakout in motion. That's just an example of how markets can hit the edge of expected moves and shoot right on through them. And that's because of rapid or urgent behavior, urgent need to get trades off or to get them in a portfolio if your portfolio is underperforming. If you're a money manager and let's say you're a little too defensive on Amazon and you want those shares in your portfolio. So that's going to help the stock or propel the stock to really just shoot through these new highs here. Remember, I like to show you candidate stocks that are making new highs, 52-week highs, and the thought process is those making new 52-week highs or strong stocks now tend to get stronger in the future. And that does lead us to risk-controlled positions like in-out spreads or bull type of verticals, but not in runaway markets, on pullbacks, on retracements, on flags. Many examples of that, including another stock that made a new 52-week high today and came away from it on some news, but it's Microsoft. So it too has overshot. This is the normal growth trend line or the normal type of range expansion or the trend type of activity where we want to get in those positions on pullbacks, but you don't have a chance to get long because it's well overextended from this 20-day moving average. So there's not a trade there. And note that we don't want to go short because that's a nice little reversal candle in an overextended market, but the darn thing went up about $10 more. So we don't really have an entry into a position or a risk controlled position to fight or fade or go against a grossly, even grotesquely overbought stock or market. That's just the market in which we trade right now. It won't be the way it exists forever, but it's the way it exists right now. So we sort of have to adopt to it either by being neutral, cautious, or standing on the sideline, or somehow avoiding the short side of the market until we get definitive proof, so trend line breaks or some other sell signal. That hasn't happened just yet. Speaking of stocks making new 52-week highs, we'll go ahead and do our scan. I did it right before the video started, and these are the typical list of stocks making new all-time highs, or 52-week highs technically. And this time, I think last video we had 60 candidates or 60 some odd candidates. We're not going to trade all of them, but we'll take a look at the main ones. And roughly 79 of the 500 stocks in the S&P 500 are joining the market at new all-time highs. And I like to sort by market cap. I actually sort two different ways. Number one is by market cap. So Microsoft, Amazon, Google, MasterCard, Home Depot, Nvidia, Salesforce, AbbVie Labs, United Technology, NextEra Energy, and Lockheed Martin. We're kind of getting down into some of the names, and we don't know that much. And if you go all the way to the bottom of the list in market cap, Assurant Inc., Fortune Brands, DaVita, we know Western Union as a type of storage device or memory for our computers, Globe Life Incorporated. We don't really know what these stocks do, at least I don't. So those really are not candidates, but they are joining the market at all-time highs. And that's just a sense of breadth or width of participation in the stock market itself. But for candidates, right, we don't just want to think ideas here. We want to get trades on. So in these type of scans or logic, this helps us to put on trades, or this is a sort list for stocks joining the market at all-time highs. And just take a look at Microsoft, Amazon, Google, MasterCard, Home Depot, just to name a few. There's Home Depot, new high. Keep in mind that, again, just kind of looking back at this, each time that Home Depot made a new 52-week high, it tended to extend. So pullbacks or retracements are where your and mine and our in-out spreads, bull verticals, or bull type of trades to manage our risk. So here's MasterCard, range expansion into the uptrend, range contraction into the end of the year, and then multiple tests or flags to the upside. We just talked about Google, which is a greatly highly priced stock, but then so is Amazon and others. Nevertheless, we would prefer to find something or categorize something as strong getting stronger, and that 52-week high list is just as good a tactic as anything, but buy it, put positions on with the pullbacks. So the most recent opportunity was just the last couple of weeks, and that target, as in structure your spread or structure your trade such that you exit the position into the profit zone or the target of the prior high. So Google has achieved that and may be pulling back. So we would expect a pullback, but in terms of risk control, you can say the same thing about this right here, that every single time the market gets overextended, maybe even if you look at candles, does a reversal candle, that's a good place to go short, but you wind up losing money. And therein lies the danger and risk inherent of fighting or fading or going against a trend. So get those pullbacks. Buy on the pullbacks like this. Takes a little bit of time, but that's the beauty of an in-out spread or a vertical. You don't need perfection. You don't need an exact entry. You just need to get the trade on from the moving average to the prior high, and that is complete. So the list goes on of those stocks, be it large cap names, which I tend to focus my attention on, stocks in the S&P 100 or in the broader S&P 500. So that's where we are in the broader picture. Market's gone a little bit chaotic. Multiple stocks joining the market. So it's bull until proven otherwise. But before we go, I'll take us right back into one little thing that gives us caution and, number one, keeps us from being extraordinarily bullish and keeps us with these in-out spreads, or keeps us with different risk twist spreads or anything else that is a defensive type of portfolio play. We've seen this picture before. It was roughly the end of 2017, end of 2018 when the market really came unhinged, went up just about every single day in January, and then fell. So it works best if you put your risk twist spreads or cautionary plays on the bigger picture, individual stocks maybe notwithstanding, but on the bigger picture, at least have something hedged, because you never know when this is going to happen. And if history is a guide, it certainly will. All right, take care, be safe, and have a good evening. This is Corey Rosenblum with your Theo Nightly video for the 11th of February, 2020.